The economic projections, unfortunately, are getting worse and worse. How are you advising investors right now to make money?
Well, the economic picture is deteriorating only because there is a second leg to the stool here, which is, we've not seen the pass-through into EPS decline for earnings to come down for companies, both public and private companies. That shoe is yet to drop, and I think that the guidance that most public companies will issue during this earnings season will tell us a lot more about what parts of the equity story to play and which parts to avoid.
Michael, what do you think? With more economists now expecting a recession, do earnings estimates need to come down even more?
Yeah, so our base case is for recession over the next 12 months, and it would be very atypical not to see earnings decline during an economic recession. Typically, you see on average 15% decline in earnings over those periods. We're very concerned about the outlook from here, given we still have premium valuations on large cap equities. By our estimate, we're at the 60th percentile on an interest rate adjusted basis. Again, that is also atypical of a recessionary environment to remain at premium valuations. So for our clients at this point in time, we are recommending an underweight to equities to compensate for that lack of recognition in the markets that economic trouble is ahead.
So underweight equities, Michael, then does that mean, what does that mean for bonds? I mean, should investors start taking advantage of the yield you can get in the bond market?
Absolutely. I mean, there are parts of the bond market where we're seeing some really interesting opportunities, particularly the short end of the yield curve, where we are picking up a decent amount of yield and less sensitivity to the rise in interest rates. You have less duration exposure on the short end of the curve. So you're relatively insulated to increases in interest rates from here. And we like cash as well, so we're overweight both cash and short-term fixed income at this point in time.
So, Naina, for investors who have been bearish on bonds and said, I've just been fully focused on the equity market, but now are looking at the yield you can generate in fixed income, where should they be looking?
Well, if you don't like equities or bonds today, you should think about how do you build diversification to other types of asset classes through different sources. So whether it's getting access to a private markets portfolio, either through private equity or through buying the permanent capital vehicles that are often listed in the major private equity funds. That's one way. The other way is to think about stocks that show resilience in these environments. So U.S. businesses that have domestic consumer bases will fare better than global ones. Services businesses will do better than goods businesses. Companies that are relatively resilient to a lower growth environment, like insurance services, healthcare services businesses, should still do well. So this is a micro opportunity, not a macro call on equities.
That makes sense. Michael, I'm looking at the economic calendar for this week. Not a lot. We have industrial production tomorrow, jobless claims as always on Thursday. It seems like the next big report that markets will be focused on will be the jobs report, which comes out in 2 weeks, right, on November 4th. But what's on your radar, though?
For us, it's jobs and inflation, and we're watching those very closely, as I'm sure is the Fed. We're still seeing a very tight labor market, mostly because labor force participation is just nowhere near where it was pre-pandemic levels, nor do we actually expect it to get back to those pre-pandemic levels, because we're bumping up a little bit here on a demographic headwind with the retiring baby boomer generation really keeping labor force participation down and leading to the tight conditions we're seeing there. We're watching these reports pretty closely along with the CPI reports for signs that sticky inflation is, maybe showing some signs of coming back down to earth. But for right now, inflation is remaining sticky. And until it shows signs of coming back down to earth, the Fed is going to remain on this tack of tightening until it gets it under control.
So, Dana, you're based in London, so I'm remiss if I don't ask you about how, as an investor, you're looking at the fast-moving political dynamic across London right now.
Yes, I think that the new Chancellor, Jeremy Hunt, has rolled back almost half of the unfunded tax cuts that were announced a couple of weeks ago by the former Chancellor. We're now looking to how much more he's going to roll back today at his press conference shortly. If he goes all the way back to zero and then figures out how he's going to increase revenue to the state to pay for the rest of the deficit, I think markets are going to react very comfortably here and say that things are almost back to normal. The issue in the UK right now, Seema, is that there's been a crisis of confidence in our markets.
Right.
And that's impacted financial stability. And that's something investors are going to look very carefully to.